Again, this is an open question to everyone. So, do you know, guys, about derivatives? Have you heard before this? What are derivatives, or what do you know about derivatives? So, please go ahead and tell me if you know this. Come on. Yes, no. All right. See, if I talk about derivatives, right? Derivatives, it means, in simple term, guys, you know, it's a contract. Name of contract, I would say, contract of financial instrument. Derivatives, it means contract of financial instruments. Now your question would be, sir, what are the the different financial instruments? See, in a finance, anything which has anything, let's say, which has a value. It could be land, or buildings, correct? Then vehicle, stocks, correct? Bond, commodities, then currencies, and even risk as well. Okay, and one more, let me add it, which is revenue from business. So these are the basically financial instruments, right? Note down this one, please, because today we're going to discuss lots of things about derivatives, and it might seems all are like new to you. Derivative is one of the easy topic, I would say, for understanding, and even interesting as well. Otherwise, most of the content which you can see would be like more theoretical of nature. So yeah, these are the types of derivatives. Not types exactly, but these are the instruments, I would say, which uh, which actually comes under your derivatives contract. And there could be, see, you might see synthetic, or more customized derivative contracts as well. Could be for, let's say, metal, steel, then agricultural goods, or it could be anything. Anything means anything. It could be any electronic equipments, digital equipments, or let's say even the weather forecast and all of that. Even cricket satta also, IPL satta, basically, I'm sure most of you guys would be betting money on IPL. But that again, that comes under derivatives, right? That comes under derivatives. There are different types of derivatives, but if you ask me, I would like to define derivatives in two ways. One is like, in general, if I talk about, or in a day to day life, you can see, which is like verbal derivatives, right? And second thing is written derivatives. So when we say written, guys, so it's a more formal derivatives, right? More formal, it means more formal. So if I talk about, let's say, stock market contracts, so we cannot go on word. After all, it's a finance, so you might lose your money if you only try to trust someone who have just committed to you. Look, I'll give you 100% profit. Look, I'll give you 20% profit, 30% profit. So you might lose your money. But what if, let's say, if you have the documentation in place which talk about terms, time period, paying party, right? Then monthly cash flow or yearly cash flow, the expected maturity of the contract. Then what if I want to discharge or take a discharge from the contract before the maturity? What about that? See, all of that, the understanding, if you want, or let's say if you want to sign contract with this feature, so it means you will have to go through the written derivatives or written derivative contract, right? This is what something it's important for. And if I talk about verbal derivative, see, might be you can see same sort of terms that party can offer, but would be kind of, let's say, just a verbal the discussion, and that verbal discussion which never help at all, right? So and again, if I talk about, guys, rural area, right? In rural area, the people, like most of the people, I would say, or around 90% people, they enter in derivative contract. But that contract should be like verbal derivative contracts. For example, let's say the especially women's, they participate in swiping rice, grains, right? With neighborhoods, am I right? That comes under verbal derivatives. But they also exchange this, they in words, they discuss about the terms, maybe quantity, all of that, and they basically exchange it. That comes under verbal derivatives. Farmers, most of the farmers, basically they book the contracts with agents for a price, right? If, let's say, nowadays the turmeric has a good price in the market, but what if, let's say, after 1 month price it could be different, maybe lower side. So farmers will lose the opportunity or profit. So what they can do, they can simply go to the nearby market and sign the contract with agent for this price. Let's say current price is 15,000 for per quintal. So they can sign the contracts for XYZ, quantity, let's say quintals, could be 10 quintals, 20 quintals, 50 quintals, right? And within a month, they'll just, arrange the turmeric. You get it, guys? So this is how the derivatives work. So it means derivatives, basically, it's not a new. In a day-to-day life, we are dealing with derivatives. Now your question would be, sir, I'm a student. How can I relate derivatives? See, maybe in your life, guys, if I talk about your college fees, maybe your college is offering, teaching or tuition facility to you, right? But you have committed to the college that, you will make a payment maybe after 6 months, maybe after maybe after 2 years, maybe after 1 year, correct? Or maybe at the end of the, let's say, period. So that all comes under derivatives, because you have committed, and college is also responsible for service, and college will provide service to you, right? You get it? Wait a minute, guys. Okay, so if I talk about, sorry, someone was texting me, so I thought like respond, at least ask him that I'm in a session. So in a day-to-day life, basically, we do a lot of things in derivatives, right? So if I talk about now, let's say written derivatives, see in a finance market or in an insurance business or even in let's say real estate business. Right. So if I talk about again financial derivatives, so if you see all are the the products, land, commodities, vehicles, currencies, stocks, risk, bonds, revenue from the businesses, that all comes under the derivative items, right? That all. Now your question would be, look, we got to know that all are the the products which can look for a derivative contracts, but how it exactly works, right? How it exactly works. See, now if I talk about, let's say, let's take example of vehicles, how that works. So if I talk about, let's say vehicle, right? Let's take example of vehicle so that you can relate, derivatives topic. Mm, where did okay. So if I talk, can you hear me, guys? Can you hear me? Or are you saying any problem? Yes, no. Okay. Not audible? Hello? No, I'm not. Let me see. Let me see. Okay. Maybe I have just connected my phone to this. I have a network issue. All right. Just I lost my Wi-Fi. I have connected to my phone. So let's see. Now, if I talk about, let's say, vehicles, how vehicles works. So if I, let's say, talk about this car, you have a car with value of 10 lakhs, right? And this is your car. It's not exactly car, but you can just consider it's your car with a value of 10 lakhs. Now, if I talk about, let's say, what will happen up to, let's say, maybe 1 month, 1 day, let's say, if something unfortunate happened with your car, then maybe you will have to you will have to pay extra money to maybe recover or protect, correct? So if I talk about the, let's say, the insurance companies, right? So can you guys try to tell me how insurance companies, let's say car insurance companies, they manage the insurance? Any guess? Come on, I'll give you 30 seconds to just think over and try to just give a try how car insurance works basically. Guys, any guess? Come on, try it. Okay, see, if I talk about insurance business, the every car owner try to purchase insurance for his or her product, right? Which is in this example, which is a car, and the car worth has a 10 lakhs. So maybe let's say on a 10 lakhs, the the car owners can pay somewhere around 50,000 to, let's say, 1 lakh for per annum. Let's say 50,000 as a insurance amount, right, to the insurance company. For example, let's say HDFC or Bajaj insurance, right? Then this amount goes to the insurance company, and this insurance company basically sign derivatives, with whom? With car owner. For what? Let's say if something happened, right? If something happened with car, condition would be if something happened with car, then you can claim, you know, money with, you can claim money with insurer, right? Correct. So for example, let's say you met with an accident, again it's an unfortunate event, and there are few damages to the there are few damages to the car, in terms of, let's say it could be, there are some fractures to the bonnet, or let's say maybe interiors or all of that, and the mechanic quoted somewhere around 2 lakhs, the expenses which is required, right? So for this 2 lakhs, the claim, 2 lakhs claim, what you can do, you can reach out to the company, this car company, and because you have paid insurance amount to them, right? And you can ask for, please claim, review my car condition and pay 2 lakhs rupees amount. You can ask for this, right? So what will happen in this case, if I talk about, let's say, the this model is all about, it's a future risk. Something if happened with my product or with my car, then the insurance company will protect, or let's say bear the recovery amount, whatever amount is required to, let's say repair the product. Insurance company will pay that amount to you. So it means, let's say to the mechanic, this is the, let's say, mechanic, and to the mechanic will receive the this amount, claim amount. So company will process the claim amount to this mechanic, and mechanic will again repair this product and hand over this product to the car owner. So in this particular transaction, guys, what you can understand, what is underlying, again it's a technical word, underlying. What is underlying? Car. So this is something, it's a assets. So assets which is in a car would be underlying product or underlying item in this particular contract, right? And if I talk about, let's say, if I talk about the derivative contract, see, in a derivative contracts, as per the definition, what would be there? Derivative contracts, it means it's a financial contract of it's a contract of financial instruments which derives the value of an underlying securities, derives the value of an underlying securities, right? So that contract, basically we can call it as a derivatives contract. So in this particular contract, you can see car would be the derivative product. And if you see this guy, let's say, or car owner met with an accident, and the repair cost was around 2 lakhs. So that 2 lakhs claim with Bajaj Insurance Company, because eventually this guy paid 50,000 amount for per year, on this for this particular car protection, right? So it means insurance company, which is Bajaj Insurance Company, sold the protection to the car owner. If something happened with car, then Bajaj Insurance will take care of it. Same, same in case of, same in case of, same in case of, I would say, what I would say, same in case with term insurance as well. With the term insurance, what happened? We try to purchase term insurance for 20 years, 30 years, 40 years, 50 years, 100 years even, right? If something happened to us within a, let's say, specified time, right, then insurance company will be responsible to repay your amount, means committed amount back, correct? And if, let's say, not happened, then eventually you will lose the premium whatever that you have paid, correct? So again, this is also comes under derivatives. There are types of derivatives, and but this is also comes under derivatives. So how it is working, like car owner is paying fixed amount to the Bajaj company, that would be the income for a Bajaj insurance. And if something happened, again the Bajaj insurance will book the liability in their balance sheet with the amount of, let's say, 1 crore, 2 crore. If something happened, or let's say for in this case the 10 lakhs Bajaj will book as a liability, then Bajaj company will have to pay that 10 lakhs or up to 10 lakhs amount back to the the insurance company. All right. So if I talk about, let's say now, how we can execute the derivative contracts in this particular situation, right? So derivatives is all about when the parties, let's say both parties, protection buyer, this car owner would be the protection buyer, right? Protection buyer. Why? Because car owner want the protection, there should be the protection seller. Protection seller. So protection seller sell the protection to the protection buyer, and protection buyer basically buy the protection and which pays the fixed amount of money to the protection seller. In case of something happened, then protection seller basically sell the that particular contracts in the market. Now the again most important question would be, what if, sir, let's say more and more people, if they submit claim, let's say Bajaj Insurance has a 1 lakh cars, right, or Bajaj Insurance sold 1 lakh car insurance in the market. What if, let's say, up to 50,000 car owners, if they file for a claim, what will happen in that case? Trust me, then Bajaj Insurance will bankrupt. Why? Because see, if the Bajaj Insurance, they are charging 50,000 something for a per year, which is a protection, and if something happened, then Bajaj Insurance will have to process claims. What if, let's say, more than 50% car owners, if they file for a claim, so it means their liability would be more if we compare with the income, and Bajaj Insurance will announce bankrupt. And that's when we can say it's a default risk. Default, it means if something happened with parties, party may announce default on payment, and that's the risk which you can see which is involved in this particular transaction. Now your question would be, sir, how can we relate this with stocks, bonds, or even other financial product? Yes, we can link. Same model, let's say if I replicate, same model if I replicate for, let's say, in a bond investment. Insurance company, LIC of India, which is again an insurance company, right? Then we have an not TCS, let's say XYZ company, right? We have an investor, okay. Let's say this investor has invested in XYZ company, and especially in the bonds of 100 quantities per share per bond price, which is 1000. So total investment which is 1 lakh, right? So this guy also invested the money, invested money in XYZ company, right? But investor is worried about the XYZ company's credit quality. What if, let's say, after few years, maybe 2 years, 3 years, even 5 years, what if, let's say, XYZ company, if condition is like ifs and buts. See, in a derivatives, without ifs and buts you can't execute the contract, right? Let's say in a derivative contract, what is happening, what will happen here? Let's say investor is worried about what will happen after 2 years. What if, let's say, XYZ company bankrupt, or maybe credit quality of XYZ company goes down? Who will take the responsibility of this investment then? See, company doesn't give a guarantee of investment return, as we have discussed in first or I think second session, right? When we discussed about stocks, we had a very long discussion around it. No company offer 100% repayment guarantee. Then who will take the or who will take the guarantee of repayment upon bankruptcy events? If that's what I said, if the bankruptcy happened, then bond holders or loan holders, equity holders, all will be in trouble. They'll have to wait until something happened, or maybe they'll have to sometime lose money as well, and that's the potential risk. So now, if I want to, let's say, protect my investment, if I want to, let's say, protect my investment, then what the investors can prefer. Investors can reach out to the insurance company, which is LIC of India, and ask for protection to the investment, right? Now, how protection works? This investor will process, let's say, payments every month. It could be 100 rupees, so for per annum would be somewhere around 1000 rupees. Not 1000 would be very high. Let's say 100 rupees per month. So yearly it could be somewhere around 12, so 1200. So 1200 rupees it will be sell it out, or send it to the LIC of India, and then LIC of India will sell the protection to the this investment, right? Now this investor is once the protection is ready, this investor is not worried about at all. Why? If something happened with, let's say, this XYZ company, then this investor can file claim with LIC of India, and LIC of India can process all the remaining amounts to the investor. So if I talk about, let's say, this investor, right? If I talk about this investor, let's say, let's take again hypothetical example, how it actually works. See, every year now we know it. This investor is paying 1,200 rupees to the LIC company for a protection. Let's say what happened in this case. Very next year there was a bad news about the XYZ company, and XYZ company announced bankruptcy, and company declared that, see, the worth of a bond is just 10 rupees that the company can pay it at the moment. So it means total amount of repayment would be somewhere only 10,000 rupees, correct? Sorry, my bad. Yeah, anyways, bond price per units. So only, let's say, 10 rupees, 10, see, from 100 to 10, it means 90 rupees it would be loss in the portfolio, correct? If I calculate loss, would be somewhere around 90 rupees per unit. So total units which are like 1,000. So it means the total units price would be, means the loss would be somewhere around, total loss would be around 90,000. So just imagine for a moment, you are investors and you have a loss of 90,000 in your portfolio due to bankruptcy. So don't you think it's it's not a good for you, right? So it's a huge loss if you lose 90% value of your investment. So it's a huge loss. Then again, if you don't have a protection, you will lose all your money, and that's what common people or retail people, they lose their everything. They lose their everything, right? But if I talk about, let's say, if you have a protection, then this loss would be your LIC of India's loss, not yours, because anyways you have a protection, and whatever loss you have, this loss, it will paid to the investor. So investor is not worried about at all. No doubt, from here only you will receive 10,000 rupees, right? Total amount you will receive, and rest amount, this company will pay you 10,000, which is the remaining value of your bonds, and rest 90,000, 90 for per units will be processed to you by LIC of India. That's what you had, protection amount, right? This derivative instruments, we can call it as a CDS, which is credit default swaps, right? Credit default swap. Default, it means bankruptcy. In case of any bankruptcy event happened, then insurance companies will process the payment to you. Let me tell you a very great recession story. What happened in Great Recession? I'll give just a high level overview what was happened in 2008. See, the America's the largest insurance group, which is AIG group. What AIG did, AIG first, basically it was again in the history of derivatives, the AIG launched this CDS product, credit default swap. There was a boom in IT industry or internet based businesses. The internet based businesses or industry had offered millions of jobs in the market with very high salary packages, and it was a very new era for entire industry. So people then started buying houses, right? But very soon in I think early 1998 somewhere, then downfall, which was started in the internet based businesses. They were facing lots of problems, and then the more and more companies, they're firing people. So let's say the XYZ person who was working with IT company, that person had a couple of properties like two, three, four, five. But suddenly, due to job loss, that same person was selling properties on discount in the market. And that was the big trouble, because for a banks to hold a property, it's not a business actually. To get the recovery of the loan amount, which is the business of a bank. But in US history, what was happening there, like most of the investors, they were surrendering the houses to the bank as a collateral, because they don't want to repay, because they lost a job in the that boom, basically, right? Bubble was busted, and basically the the job seekers or job workers, they're facing lots of issues. And then that actually started real problem, like more and more people, they were selling houses back to the bank instead of paying EMIs. Then bank were in trouble. But again in 2000, somewhere, the AIG entered, and AIG decided to sell the CDS, like ask bank like not to stop for you know loans. Do one thing, sell it out more and more loans. So what I'll do, I'll provide you protection CDS. Even if let's say home buyer default, then we will settle your claims amount, so you don't need to worry about it. So in that, means in that the CDS process, basically the Bank of America, then uh, then your the JP, not JP Morgan, yeah, but JP Morgan, Goldman Sachs, and Lehman Brothers, and there was one more bank. So they basically, all the banks aggressively participated in home loans, and during the recession also, they just sold out the loans to the home buyers. And on other hand, the all banks purchased CDS from the AIG group. But within just 2 to 3 years of time span, around like 2006 or 7, it somewhere 7 somewhere, the most of the banks, they were filing for claims, because as I said, the default home buyer default rate, it was suddenly spiked. And due to that, most of the the banks like JP, Goldman, or all of the the Wall Street banks, they were filing claims with insurance company, AIG group insurance company, for a claim. Because that's what the meaning of CDS is. Contractually, banks are obliged to pay the claim amount if something happened with the product. See, early 2008, finally AIG group announced bankrupt, saying that we don't have a cash in the pocket to pay settle the claims. And that's when most of the banks you know uh, just got in trouble. Why? Because they felt AIG will take care of it everything if something happened, and that's what they sold out loans in the market. And now AIG said that AIG don't have a cash to settle the claim, and that was the actually the bubble busted. There was a bubble along with this CDS, and actually that bubble busted, and America announced that they have a great recession. And finally the AIG, means insurance group, they couldn't settle the settlement of uh, Lehman and Brothers. And then finally, we know it, the history of Lehman and Brothers, the investment banks, the great investment banks collapsed. And the Barclays Bank and HSBC, both bank purchased the that bankrupt bank on a discounted rate, and that bank is now nowhere in the history. I mean, it's become history now. It's not in present. See, the point here is, guys, see, derivatives, of course, which provide protection to your investment, but that doesn't mean the derivatives which are like good for investments as well. So it is all about like how you effectively utilize this product. It matter most. One mistake the AIG group did, they just announced you can take ample amount of risk, will take care of it, your risk, correct? But at then what happened, risk taker was only in problem and entire market crash. So this CDS instruments, the experts, they call it as a disruptor, market disruptor, because this push parties to take more and more risk. See, if you have a protection, so it means, for example, let's say you have a term insurance, so you can, without fear, you can do anything, because if something happened with you, bank will, sorry, insurance company will take care of you. They'll spend money on your recovery, or maybe they'll give money to your family, so you don't need to worry about it. Then people, they'll, of course, they'll not worry about anything. They'll just do whatever they want, and before the expiry of the insurance, they'll just kill themselves, right? And if this happened, so more and more settlement request will goes to the insurance company then, and company will bankrupt. So this is how the CDS works basically. So when we say CDS, it's a credit default swaps. And in a credit default swap, what is important, guys? The important is, if more and more claims receive for settlement, then default credit default seller, which is, of course, insurance companies only, they are allowed to sell, so insurance companies would be in trouble. That's what expert says. It's a market disruptor or highly risky product. All right, so any question around CDS, guys? Come on, any question? Mirdula, yeah, you can say it's like EMI, but in terms of, let's say, the accounting or reporting, we treat as a premium, not, because when we say EMI, it means actually we are paying back interest and principal. But yeah, so way of making payment could be like EMI only. So how does big company like that offer the money they don't have in the first place? How does big company like that offer the money they don't have in the first place? Can you elaborate more? I'll wait. Just try to elaborate it if you can. Logeshwar, what do you mean basically? Yeah, agree. You're right. See, they had a money, but basically, insurance company like AIG Group was in overconfidence, like, if something happens, so they'll take care of it. But their money just account, dried, just drain in just uh, 1.6 to 7, means in just 70 to 18 months. And then actually means real problems started, because the most of the investment banks, they took a risk because of insurance company took a risk actually, right, on financial instruments. But if let's say when the insurance company receive lots of claims, they just declare as a bankrupt, so that they are not in a position to settle it. So that was the actual problem in this entire the story. Right? And it's a very bad thing if you don't have a cash, and if you try to push yourself for a higher risk. then you might lose. What was the closer for the investors? See, investors, most of the investors, even they lost money in recession, right? See, ultimately, the risk of investor in this, if I go back, if I talk about risk, what if let's say LIC of India says they don't have a cash to settle this 90,000, then this investor will lose money. Correct. So that's the default risk. See, if insurance seller only announced default, because in 2008 recession, what happened? Insurance seller only announced, uh, you know, they don't have a cash and they want to file for a bankruptcy. Are you getting my point? So if insurance company announce default it means they are unable to make a payment, then investor will lose money. That's the risk. But that would be like again a worse situation. See, in a finance, nothing is guaranteed, nothing is like fixed. It's all about we can just predict and say this will happen, this will not happen, but that doesn't mean let's say everything will be all right and you can have it. No. Okay. So what we'll do, we'll take a pause here and we'll take a break of 10 to 15 minutes. We'll connect in 15 minutes and we'll continue our session afterwards. All right. So we'll connect at maybe 10 guys, 13, 20 minutes or 15, or maybe we can connect at 9:50, whichever is fine. Mirdula, insurance companies earn profit through premium because investor pays premium, right? So that premium is the income of the insurance companies. So what do you mean, Logesh? Again, I am not able to understand it. If you can just try to explain through few points. Isn't that the point we insure in the first place? What do you mean but? What was the closer it means? Which closer we are talking about? I was talking about the not particular. So actually, the insurance company pushed the the investment banks to take more risk, right? And that's when if you push yourself also for a more risk, and if you lose your money, so you will not have enough cash to means cover your debt, right? See, anyways, if any insurance company is selling a protection, it means they are just they are just creating their more and more liability and they are making money out of it. See, the point is, let's say you are an insurance company. You have now 1,000 crores in your pocket, and that's what you sold insurance protection to the thousands of people. What if, let's say, all thousands of people file claims with you? So, do you really think that you will fulfill the, all 100% claims? No, no one can do it, and that's the risk. That always you can see a risk. So, we can't do anything with that. See, we have now, see, in 2008 there wasn't like insurance regulatory and all, but now the world is very smart. We have insurance regulatory. Uh, if I talk about India, the IRDA, always they review the cash flow and everything in place, and they restrict companies, means insurance companies, like not to invest huge money in the financial instruments. They always protect. So that happened. It goes, this ball like you know round and round. Yes, that's the worst case, and I was talking about worst only. But what I said, see, that was a story incident what happened in 2008, and same thing even can happen in the normal life as well. If any company, let's say, overcommit to someone, look, I'm ready to take all the risk. But what if something happened with that company? We can't do anything then. We lose the money. But in general, if the let's say if any company which is in a sound position, then there is no risk. If the company, if they received more and more claims, then there would be a problem. Okay, so we'll see you next. Sorry, we'll see you at 10. Let's take a break, have a dinner. We'll get back. We'll connect at 10 p.m. बोल ना. बोल ना. आलो नाही, जाणार आहे. नाही ना. हम्म, हम्म, हम्म. हम्म, हम्म. तुला काय काय पेपर पाहिजे त्याची लिस्ट पाठवून दे ना जरा. ओके. मला पाठवून दे, मी पाहतोय तेच. मला पाठवून दे आपले. काय म्हणतात, 2-4 दिवस जरा बिझी होतो रे. Hi. Can you hear me, guys? I hope you had a dinner. My dinner is still pending, but yeah, I'll do it later on. Can you hear me? Am I audible, students? Okay, all right. Okay, let me share my screen.